The baby powder controversy has continued to impact Johnson & Johnson's share price. Year to date, they are down roughly 11%, and over the last year, they are down roughly 8.5%. They are scrambling to find ways to deal with more than 40,000 lawsuits, and the company has issued cautious forecasts for 2023 in the wake of inflation. Traditionally, Johnson & Johnson have traded at a premium partly due to the AAA credit rating, but due to the recent slide in share price, in this video I want to take a closer look at the intrinsic value of Johnson & Johnson and take a closer look whether or not it is a buy at the current levels. And one more thing before we go into that. Take a look at this dividend growth streak, 60 years of consecutive increases and an uninterrupted dividend streak of 107 years without a reduction, and the dividend growth you can see here is up and to the right, just as we would like to see it. Let's jump into our stock screener and punch in JNJ, the stock ticker for Johnson & Johnson, wait for everything to auto-populate, and you can see the current price is 158.91 at the current time. PE non-GAAP forward ratio of 14.45, which is roughly 10% lower than the 5-year average. Dividend yield of 3% and a payout ratio above the 60% limit at 93%, mainly due to a lack of cash flow in the recent reports. So in the long term, I wouldn't worry too much about that. Recently, it had a 52-week low of 150 and an analyst target price of 179, EPS growth at 5.3% and then return on equity at 17%. Let's jump into the dividend data tab, zoom in a little bit so we can see everything better. You can see here the dividend growth rate over the last 10 years is 6%. And also, if we take a closer look at all the different numbers here in the different cells, you can see that it's roughly the same. So it's a pretty steady grower at around these 6% over the many last years. Scrolling down here to the dividend yield theory graphs, you can see the dividend yield here thinks that it could be at an 8% discount. The 5-year dividend yield over here, you can see it is in the blue area, which could indicate it being undervalued. If it goes below the line here down in red area, that could indicate that it's being traded at a premium or overvalued. Let's jump into the first valuation model, where we do have Graham's revised valuation model, where we do take the EPS, the PE of North Dakota company, combine it with the growth rate, the average yield of AAA corporate bonds, and the current yield of AAA corporate bonds. We then arrive at an intrinsic value of $54. Jumping into the next one, the discounted cash flow model, where we do take the free cash flow from the different years. We then apply a growth rate to project them into the future as future free cash flow. Discount that back to a present value using a discount rate of 9%, combined with the cash and cash equivalents, total debt, shares outstanding, we arrive at a fair value per share of $102. Next model is the dividend discount model, where we take the dividend payout from the different years, combine it with an average growth rate of around the 6% as mentioned, combine that with the weighted average cost of capital, we then arrive at a massive intrinsic value of $479. We then also have the multiples valuation, where we do take some of Johnson & Johnson's peers, you can see them here. We do take their PE multiples, median or average them together, combine that with the EPS from Johnson & Johnson, and then we have a stock price of $209. Next one is the free cash flow valuation, where we do take the price to free cash flow ratio from the different years. We then average all those together, combine it with the free cash flow per share. We then arrive at an intrinsic value of $121. The last model is the Peter Lynch model, where we take the growth rate, the dividend yield, the PE ratio of Johnson & Johnson, combine those together to arrive at an intrinsic value of $80. And if you haven't checked out my latest video, where I go a step-by-step tutorial on how you can make this model yourself, go and check that out. Before we jump into the summary, thank you so much for watching, and if you've come so far, please subscribe to my channel if you're not already doing that, and like the video. Let's jump into the summary, where we do have our 6 different valuation models. I choose to include all of them because I think all of them are pretty okay. Graham's being on the low side, but again, dividend discount being very much high. I think those two even each other out a bit. The average intrinsic value is $174. The current price being $158, there could be an average current discount of around 9%, which is pretty much in line with what we saw earlier, the PE ratio being 10% below the 5-year average, and also the 8% discount according to the dividend yield theory. We can then also apply a margin of safety of, let's say, 10%. We then arrive at an acceptable buy price of $157, which is in line with the current price of $158. At the current levels, I would definitely load up on Johnson & Johnson if you like the long-term outlook of the company. It's very rare that you can get this gem with a AAA credit rating at fair value, which I think is right now. Normally it is being traded at a premium as mentioned earlier. So again, if you do like the company, I think these are very reasonable levels to load up on the stock. Thank you so much for watching, and I'll be seeing you in the next video.